Quantitative tightening news. What happened in the market in 2022? Generally, the central bank tries to keep inflation at 2% yearly by promoting employment and maintaining the prices of commodities. But recently, we have seen record breaking inflation of 8.6%, which has made people worried. The price of fuel is also touching the skies, so it becomes difficult for an average person to save money. Now, the Fed has decided to reduce the supply of monetary reserves by squeezing its balance sheet, and it is assumed that it will help in controlling inflation. At a high level, it's just the reversal of the stimulus that the central bank enacted following the financial crisis back in 2008 and the COVID-19 pandemic outbreak. And as the measure tightens the capital market, it is assumed that it will alleviate some inflation. Hello guys, welcome back to my YouTube channel. In this video, I'm going to tell you about quantitative tightening news. Quantitative tightening explained. A few years ago, you might have heard of the term quantitative easing in the discussion about Federal Reserve and monetary policy, in which the central bank creates the money digitally and uses that new money to purchase assets, typically government bonds, on the open market, by inserting itself into the market as a buyer. The central bank causes a sort of domino effect in the financial markets. In a nutshell, quantitative easing is a measure by Fed to lower market rates to ease financial markets. Recently, you have heard the word quantitative tightening. Quantitative tightening happens after the quantitative easing as the central bank squeezes their balance sheet to control the negative outcomes such as skyrocketing inflation. We all know that the main duty of the Fed is to make the economy of the country strong by maintaining the prices of the commodities and keeping the unemployment ratio low. It does this by handling the Fed funds rate, which it sets at its Federal Open Market Committee meetings. This successfully increases or decreases the interest rates that financial institutions and banks offer corporations and individual customers for things like mortgage loans, student loans, and other loans like credit cards. In case the interest rates are already low and the economy needs assistance, then the Federal Reserve must look for other tools in its arsenals, like quantitative easing or quantitative tightening. How does it work? The Federal Reserve squeezes the supply of its monetary reserve just by letting the bonds and the other securities it has bought reach maturity. When this occurs, the Treasury Department eradicates them from its cash balances, and thus the money it has produced efficiently vanishes. Actually, there is one problem. Quantitative tightening has never been applied successfully before, as this is a contraction measure and puts pressure on demand. It could prove to be a dangerous policy for the financial markets, and it might create a sense of fear for investors. Back in 2018, the U.S. tried to implement the squeezing policy. It led to a pretty adverse reaction from the market, and therefore forced the Fed to put off the policy. The quantitative tightening has begun by squeezing the Fed's $9 trillion balance sheet, along with the steep rate increase to control the persistent inflation. Now, the Fed has no choice but to tackle the persistent inflation and get back to achieving its target of 2% inflation annually. Recently, the Central Bank of America has decided to stop pumping the proceeds of an initial $15 billion of maturing treasuries back into the $23 trillion markets for the U.S. government debt. The central bank has done this for the first time since it started its bond buying program in the early days of the pandemic outbreak. While the Federal Reserve has labeled its plan in advance as QT or quantitative tightening, this step has put the investors in confusion about what will the impacts of this move on markets, as this process has never been tried before on such a large scale. This step can also impact the bond market significantly, which is already being battered by speculation as to the decision of the Fed to increase the interest rates. According to the Chief Investment Officer, Rick Ryder, the Federal Reserve has a significant influence on the markets as it has become an important buyer for a few years. After losing it, and the uncertainty due to high inflation will also increase the instability in markets. The balance sheet of the Federal Reserve has swollen. Participants of the Federal Open Market Committee in May officially approved capping the runoff at an initial pace of $30 billion a month for Treasuries and $17.5 billion for agency mortgage-backed securities, before boosting over 3 months to the highest pace of $60 billion and $35 billion. This means it can go as much as $95 billion each month. When the amount of maturing treasuring reduces below the verge, the Federal Reserve will make up the difference by declining its holdings of short-dated Treasury bills. Active sales of an agency will also be measured. This stance is much more aggressive than the previous balance sheet relaxation during the period of 2017 to 2019, which started about 2 years when the Federal Reserve lifted the interest for the first time since the international financial catastrophe. However, that move ruined the markets. If we talk about this time what is going to happen, it's not sure where the pain will be, though the Federal Reserve has numerous emergency faculties in the arsenal that may assist in fending off a repeat of the 2019 market chaos. The expectation of increasing interest rates after the 2 reports in the recent days shows a growing risk that inflation will become more deeply entrenched. Modification to the Fed's main policy rate is seen as having a straight impact on the financial state and economic action than QT. But the experts anticipate balance sheet runoff to have an effect as well. When the Federal Reserve purchases bonds, it automatically credits the seller, in turn adding reserves to the banking system that then enable banks to upsurge their lendings to people and companies. By stopping to reinvest the profits of its bonds portfolio, the method reverses, lending to a couple of reverses in the system and squeezing the financial condition. The central bank has issued a paper before this month. Researchers guessed that plummeting the size of the balance sheet by $2.5 trillion over the next some years is roughly equivalent to increasing the federal funds rate by merely more than 0.5 percent points on a continued basis. They caveated their findings with a disclosure, however, that the estimate is related to significant indecision. Are the quantitative tightening fears exaggerated? The analysts of Morgan Stanley have a simple message for everyone who is worried about how the market will respond to this move, as it will be the biggest contraction of all time. So far, the quantitative tightening has been tried only once, when the Fed, the Bank of England, and the Bank of Japan in 2018 and 2019 together squeezed their balance sheet by around $0.8 trillion. Janet Yellen joked at the time that the step would be as exciting as watching paint dry. But that was then. With the skyrocketing inflation, Morgan Stanley, which is an American multinational investment management and financial service company, predicts that G4 central banks will have to run off an enormous $4 trillion worth of assets through the end of the coming year. The Fed's chairman, Jerome Powell, says that he has no reason to think QT will lead to liquidity problems. On a question about whether this move will adversely impact the financial market, the chairman of the Fed, Jerome Powell, said that he has no reason to think that quantitative tightening will lead to a liquidity problem. He said that we are carefully analyzing the reasons why inflation has risen so much, that even we did not expect that. This inflation is behaving differently due to certain factors, such as shutdowns in China, the war between Russia and Ukraine, and it is difficult to control this type of inflation without changing the supply side. He further talked about the QT. The Fed has communicated with the market, and they seem to be fine with this move. That's all for today's video, and thanks for watching. If you liked it, make sure to give it thumbs up and share it with your friends. I will see you in the next video. Take care and stay tuned.